Hello, good evening, and welcome to the third and final episode in our series of webinars looking at SIPs. Tonight we're joined by Francis Moore, as always. Francis, Chief Executive of European Pension Management. I'm David Gill, Head of Product Management at Self-Trade, and tonight we're going to be looking at perhaps the enjoyable end of SIPs, which is taking the pension benefits in your retirement. Obviously, the reason you're all interested in managing your own pensions is to provide an enjoyable retirement once you finish working. So that's what we're going to be looking at tonight. Before that, just a quick reminder of the details of the platform. If you've not used it before, you'll see a box on there where you can enter your questions. Indeed, we've got a couple come through already this evening, so it looks like we should be in for some lively debate. So to enter a question, just type it into the box, press submit. If you see a request to enter your email address, please fill that in. It does let us know who sent the question through, and if we need to follow up for you afterwards, then we can do so. So that's the details of the platform. You'll see the questions coming up in the panel above Francis's biography, which is to the right of the video screen. So you can keep track of those as they're coming through. Do send a question at any time. And of course, if you'd like to leave us some feedback, we'd very much appreciate that. So you can use the feedback section to do that. So turning to tonight's webinar. So as I said, we're going to be looking at taking retirement benefits. But before we do that, Francis is also going to spend a few minutes looking at the question that we touched on last week, but deserves a little bit more time, and that's the question of taxable property. So Francis is with us as ever. And Francis, I remember last week we were talking about you going off to the Shares Awards. And I have some good news for our friends who have joined us tonight, and that's to say that between us, Self-Trade and Francis and our other trustees that we work with, Self-Trade has picked up the Best SIP Provider Award from the Shares magazine readers. So thank you if you voted for us, and we're holding our breath and crossing our fingers for next week when it's the Investors Chronicle Awards as well. So we're up for that one, so do keep an eye on our website and we'll let you know how we get on. So, to tonight, and Francis.
Well, thanks very much, Dave, and we're basking in reflected glory as our partnership, so it was a very worthwhile evening. Tonight, as Dave has intimated, I'm going to just start by throwing in another topic, which is taxable property within the pensions environment. This topic was brought about through the pension simplification that came in April 2006, which swept away all of the prescribed rules about investments that had hitherto been the case, where investments were prescribed by HM Revenue and Customs. And essentially we came to a situation where almost any investment is allowed, but certain investments are on the prescribed list, and they're, if held directly, are deemed to be taxable property. And these include sort of chattels, residential property, tangible assets, which are art, antiques, jewellery, fine wine, classic cars, and yachts. And I touched on yachts last year because it's always been a favourite question of SIP members who want to go into wider investments. Can they have a yacht and then charter it out to make a business income? Well, sadly, it's foursquare in the middle of taxable property, just as our racehorses. So unfortunately, the taxman doesn't want you to necessarily enjoy your assets as well as making money out of them. Currently, the rules around taxable property are divided into direct and indirect holdings. Obviously, it's quite obvious that if your SIP holds one of these things directly, then yeah, it's a direct holding. But where it gets more difficult, and where we as trustees and administrators have more of an issue, is where assets are held within what we deem to be a vehicle. So that might be a company, or it might be a fund, which actually holds the asset, so it's masked. But that doesn't mean to say that taxable property won't apply. So it's very important for us, particularly when we're looking into things like private company shares, etc., to make sure that it's not a vehicle that's actually masking residential property or some of these direct tangible assets. One of the issues that we as an industry faced through the conversion into A-Day, as we called it, into the new regime, was that, for instance, ground rents were permitted under the old regulations, but they are not permitted under the new regulations. They become taxable if they're connected to residential property. And what has been sensibly done is there's some amelioration. So if the status quo stays, then there's not going to be a taxable property issue. However, if it does change, then what we see there is taxable property applying. Now I'm hoping that my video prompt is going to just move on a little bit. We seem to have a little hitch, sorry about that. I can sort of go on basically in that I wanted to start talking about the tax rates that would apply if an asset is deemed to be taxable property. And the situation there, as we coming on now, well done, is that holding assets will have an unauthorised payment tax charge on the member at 40% of the tax charge on the value of the unauthorised payment to secure that asset. There's also a scheme sanction charge payable by the scheme administrator on the income that the asset produces, and that's 15%. And tax on the income generated by the asset, that's going to be a tax charge of 40% on the income, and if the income is less than 10% of the value of the asset, then the tax charge will be calculated as if the yield was 10%. If there's no income, there's no tax charge. So just running through a very simple example, if an asset's worth £100 and deemed to be taxable property, there'll be an unauthorised payment tax charge of £40, a scheme sanction charge of £15. Effectively, that's an effective immediate tax rate of 55%. And then if the income in the year was £5, that would be deemed to be £10, and the tax charge would be £4. But there's more to come. If you then, as we would expect, dispose of the asset, then there will be capital gains tax payable in full and no indexation. So that's a pretty heavy penalty. Where a pension scheme holds residential property that's initially let out to a person who's required to occupy it as a condition of employment, then that's permitted. There's not an issue there, but what we have to again make sure is there's no family members sneaking in to take advantage of that nice concession. Assets which are not considered to be taxable property again include a tangible asset such as property if it's purchased through a genuinely diverse vehicle. Now, example I used last week was that residential property is not banned per se, it's just subject to this draconian tax charge. But if you buy it through a fund and you have sufficient assets, and basically the criteria, the genuinely diverse vehicle criteria, where the fund needs to be at least £1 million, no one property can be more than 40%, and you must have 3 or more properties, then as a genuinely diverse vehicle, that would be permitted. But again, care needs to be exercised because when you're building up your fund, if you have 1 or 2 properties, you don't meet the GDV criteria, so taxable property would apply. Similarly, when a fund's being wound down and you're left with 2 or 1 properties, you again run into a situation where taxable property would apply. Well, I hope I've given you a flavour of taxable property and the very, very draconian tax charges that can apply if you get it wrong. And it's fairly simple through direct assets, but it's the indirect ones that we have to look very, very carefully at. And that is why I've always said that when you're buying and selling investments, it's so easy to deal on the stock market. At the press of a button, you can do it beautifully through the self-trade platform, either on the internet or by telephone. But when you move off these platforms and we're having to buy assets directly, which are not listed assets, it becomes very complex. Now, Dave was suggesting I was going to go on into retirement benefits, but one of the areas that sadly we have to deal with from time to time is a member who dies. Now, one of the things that we ask for when you set up your SIPP is for you to nominate a beneficiary. Now, nominating a beneficiary under an expression of wish exempts the fund from inheritance or the lump sum being paid in terms of inheritance tax. So it can be paid out in full. If you were to make a direction to us and you forced us to pay a particular person in some way, then there would be no exemption from inheritance tax. So it's very important, firstly, to always make sure that your details in terms of those that you would like to be your nominated beneficiaries, should some unforeseen accident occur, then that's important, because then as trustees we can then go back to the will, to the executors, double check that there's no contest. And indeed, one of the issues that we do run into from time to time is that there are stresses and strains about who should receive that lump sum. Now, if you've not retired, the rules really break down into two parts. Pre-retirement, and what we have to call that is now benefit crystallisation. Essentially, there's a lump sum which is now limited to 1.8 million up to 2012, and then it's proposed that a new lifetime limit is going to come in from of 1.5 million. The second option is effectively to create dependents' pensions, and if there's a value over the lifetime limit, there'll be no tax on the fund used to buy the pension or unsecured pension if over 77. We then have a situation in terms of death after benefit crystallisation, where we could have a form of benefits in terms of a lump sum or an annuity and income. And the tax consequences on unsecured pension are currently a tax rate if income drawdown lump sum is taken of 35%. If the dependent pension continues in unsecured pension, or is currently in alternatively secured pension, and I'll come back to that in a moment, then the income is taxed at the marginal rate. Alternatively secured pension, and that was brought in almost by accident in a way in the pension simplification through the lobbying by the Plymouth Brethren, who effectively said that they couldn't deal with pooling of assets. And so the government came up with this solution called alternatively secured pension, but they didn't really at the time want to move away from compulsory annuitisation. And then, you know, like all these things, human rights came into the thing, and so you can't give it to one party without offering it to another party. So alternatively secured pension came into play, but effectively it became draconian in terms of death in alternatively secured pension with an effective rate of 82%. The dependent pension now is being moved into a new regime, but I'll come back to that again. Also in ASP there's the dependent's annuity, which is for death benefit purposes is for any member's spouse or civil partner or children under 23, considered as being a dependent for also disabled relative or an unmarried partner. If there are no dependents, a death benefit payment would be an unauthorised payment under the rules. It's I'm afraid, complex area. And an inheritance tax charge, as I've said, of 82% or more would apply. Now, some providers are not prepared to make unauthorised payments per se. So there is a sort of a get-out, which is that for those in ASP, it's possible for the death benefit to be paid to a charity nominated by the member. Now, we're in transition at the moment. When the government came in, they quite rightly saw the very significant complexity in alternatively secured pensions and the death benefit regime. And essentially, one of the first things that they did was they actually moved the requirement to move into either an annuity or to alternatively secured pension from the age of 75 to the age of 77. So that's deferred. However, those members that are already in unsecured pension, unfortunately, have to stay in alternatively secured pension. So that's something that's going to need to be sorted out. There's been a consultation on the right rate for the lump sum death benefit, and this is possibly where there's some less good news for those that are in unsecured pension, because currently that's 35%. We've had the draconian rate for alternatively secured pension at 82%, and at the moment the government's ideas are around that it might be in the 55% level. So that actually means that more people may have to pay more tax in unsecured pension going forwards on death. But that we're going to have to wait and see, and is all part of the consultation. In terms of death benefits, I think that sort of probably takes care of what is quite a complex area. But the important thing, as I said, is to make sure that you've completed those nominated beneficiaries, you keep those nominated beneficiaries up to date. And as I said, we as a trustee will always go back and double check in the unfortunate event of your death to make sure that things are consistent with the will, etc. But at the end of the day, and I think this is an important point, and maybe something for you to consider when you're selecting your SIPP provider, is that as trustee, we do have absolute discretion at the end of the day as to who gets paid out. And sometimes, unfortunately, we have to exercise that discretion where there is a dispute between parties. And I want to move on to that exciting area that Dave was talking about, which is in terms of the retirement options available to you. Within the last few years, we've seen the retirement age move, the minimum retirement age move from 50. There were even special categories for sportsmen and other people who might reasonably expect, rugby players and others, might reasonably expect to retire earlier. But the retirement age now has been moved to 55 and runs through to the nominal 75, although, as we've just been discovering, effectively that moves to 77. And effectively, by that age, you must start to take benefits either in the form of annuity or unsecured pension by that age. Now, one of the questions that we often get is, well, what happens if I'm ill? Can I retire early due to ill health? And yes, you can, subject to providing medical evidence. And it's important that that's properly documented. If you're terminally ill, then the fund can be paid free of tax as a lump sum. But again, there needs to be very strong medical evidence to support that situation. For instance, another issue is that you might not actually have a very large pension. And there has been a concept called what we call trivial commutation, and effectively that's a percentage of the lifetime allowance. And actually it's something that's just reminded me, I must find out now whether with the reduction in lifetime allowance the commutation is actually going to fall under 18,000 and whether it will actually come back to 15,000. But effectively, if you have a situation where all your pension benefits, so you can't pick and choose here, you can't say, well, I've got a little pension over here and another little pension over there, so I'll have a bit of trivial commutation here and a bit of trivial commutation there. You can't do that. It has to be the aggregation of all your benefits. And if that's the case, then quite sensibly it can be paid out as a lump sum, a quarter of which, 25%, is paid tax-free in line with the usual benefits, and the other balance is added to income and taxed at the marginal rate. Now, the important thing with retirement benefits is that it's not just the arrangement that you might have, a SIPP, you may have other pension benefits. And as I was saying in previous webinars, when we come to assess the benefits that we can pay out, we have to take into account the lifetime allowance limit and how much you might have already crystallised, how much you might have taken by way of a pension commencement lump sum and other benefits. And effectively, you can't get away with taking more here and more there in terms of growth, because you may be taking, for instance, if you take your maximum tax-free cash, you can't come back and have another bite at it. Well, the important thing about pensions is the fact that you get part of the fund paid out tax-free. Now remember, you're getting tax relief on the way in. You might have a basic rate tax, you might be getting tax relief at the marginal rate, but also remember that when you come to take the benefits in the form of income, you will be taxed at your marginal rate. So that could be at basic rate, or it could be, in this year, at 50%. So the fact that you can take a tax-free cash sum of up to 25% of the fund is very important. Now, in terms of the income, the balance of the fund can be used to secure income. Now, there's all sorts of opportunities here in terms of annuities, or taking unsecured pension, or taking alternatively secured pension. One of the things that's often talked about is, why should I buy an annuity? Well, okay, they may not be particularly good value at the moment with low interest rates, but people are living longer. And the one thing that's certain about an annuity is that when you buy it, it will pay that prescribed level of income for life. So although perhaps for investors the natural inclination is to attempt to protect that investment by going into unsecured pension, I want to come back later in terms of looking at the risks. Annuities too are developing further, because we now have the concept of temporary annuities, and you can sort of mix and match now in terms of retirement income, maybe securing part as an annuity, part as a temporary annuity, and also taking part of your fund as unsecured pension, where you can continue investing. Now, the calculation of annuity rates is going to be based on your mortality, i.e. the age that you're going to be taking retirement benefits, and effectively the actuarial calculation, the mortality calculation of when your pool of people at the same age might die. And that's how a life company annuity provider is going to calculate the rates. But one of the key drivers is interest. And in exactly the same situation is with unsecured pension. So if someone's coming to us and wants to take unsecured pension, then we need to know their age, we need to know your sex, obviously, because there's a difference in mortality between male and females. And the most important thing is the rate of interest that prevails at the time, which actually we take from 15-year gilt yields in the month before the USP illustration is being done. And that's a standard process across all providers. Now, in terms of annuity risks, terms fixed, as I've said at the outset, give certainty, but no flexibility if your circumstances change. So you have fixed dynamics. You might set your rates to escalate with inflation, and that will happen. The capital sum that you pay to the life company or to the annuity provider becomes their property. They are then taking the bet in terms of how long you live and in terms of the income that they're paying. If you die early, the sad thing is that much of your fund may be lost, although there are ways of mitigating it by including guaranteed periods, etc. For those of you who are investing and you think you're going to outperform in terms of your retirement funds and to keep it going, don't think that income drawdown doesn't have risks. It really does have potential risks. I mean, what if your investment performance doesn't actually keep pace? So it's something called mortality drag in terms of your age increasing. If you take too much income from your fund relative to its investment performance, you can deplete that fund. And one of the things that you need to keep in mind is, well, perhaps having enjoyed income drawdown and the flexibility of continuing to invest your fund whilst paying out an income, at some point it may be more suitable for you to actually have an annuity. And if you've depleted your fund, you may actually find that you're in the sad situation that whilst you've enjoyed doing the investment, you end up with less income for the remainder of your life than would have been the case if you had bought an annuity at outset. So really what I'm trying to say is that retirement income, as much as it's fun, as much as you get tax-free cash, and these days you can have much more flexibility, is probably one of the biggest decisions you're ever going to make in terms of future funding of the family income. Now, one of the things that has been coming up through the summer with the coalition government coming into power is that in July, not only did they launch, and you'll go back to the first webinar when we were talking about the changes to the contribution limits, were also squirreled away in the summer month, or only about a month in fact, in August, were new proposals for retirement options. Now, essentially, the first step has already been put into place, which is that alternatively secured pension has been swept away for age 75. Those of you, as I said, are already in an alternatively secured pension have got to stay there. But basically now, unless you get to age 77, then ASP's pushed away now. With ASP, one of the detractions from it was that you had to take your pension commencement lump sum by age 75. And this is now going to be swept away. So some good news here is that the flexibility in retirement is not going to be caught around this age 75, which was the case before. And in some ways, this is the sweeping away of compulsory annuitisation, although, as we've explained, it had already been swept away to a degree. The calculation of trivial or small funds that can be taken as cash will not be linked anymore to 1% of the lifetime allowance. So perhaps I'm answering my question there, that with the lifetime allowance coming down to 1.5% of 1.5 million, we'd expect trivial commutation to come down to 1.5, but that's something that's been consulted on. But one of the things that everyone needs to be aware of is that the lifetime allowance is coming down from 1.8 million to 1.5 million in 2012. Now, for those of you that are challenging that limits or that range, remember there's going to be a significant tax charge if you have a fund in excess of the lifetime allowance, and we explained that in the earlier webinars. So what we're already seeing in the market is people within that category, people who perhaps may also have retirement benefits plans as well. So remember, it's this lifetime allowance that you have to test of all your pension arrangements, that we're getting people now coming to us and saying, right, we need to crystallise our benefits. Another way of ameliorating this reduction in the lifetime allowance is for those that are actually moving abroad. And in some circumstances, it may be sensible for those with UK pension funds who are moving abroad to think about taking out a qualifying recognised overseas pension scheme, which is moving your scheme to an overseas scheme, where perhaps within the rules of the scheme there are not going to be the same limits applied in terms of lifetime allowance, etc. So that's for our more international customers to think about. But it's something, again, where we're seeing a means of ameliorating this cap on lifetime allowance. There's also a suggestion that unsecured pension could be taken at higher limits, subject to evidence that a minimum secure income. Now that's been mooted at about £10,000 to £15,000 a year. And the idea there really is to take people out of the need for state provision, and if you can demonstrate that, then effectively the government's saying that you can be much more flexible in the way that you take your retirement benefits. So all these things are under consultation at the moment, but one thing's for sure, the old idea that you just paid your money in and you ended up taking a bit of cash and having to have an annuity is swept away. We are going to see, and I think rightly, we're going to see a much more flexible retirement zone where there will be much more scope to mix and match the way in which you take your benefits to really support your lifestyle in retirement. So Dave, that's my scoot through the retirement zone.
Well, thank you, Francis, and I think certainly there's a lot for people to take in there. Do remember that quite a lot of the things that Francis is talking about at the end there are the things that are under consideration, and I'm sure, Francis, if I can make an offer on your behalf, if I may, is to say that we'll keep updating the Self-Trade website as new news comes through. So do keep an eye on there, and I'm sure on Francis's own website you'll find more information as well as it will be covered in the national press. So do keep an eye on that, because I think it is important to try and keep track of what's happening to these changes as they become a bit clearer. So now we've been having some questions come through as always. So Francis, if we could dive straight into the questions, I think that would be good to do. So we had an early on question from Peter, who's really wants to know how you actually work out how much you need to put into your pension in order to get out your target income. So Francis, the magic number.
Well, it all depends. And why I say it all depends is that one of the key drivers for how much you need is, well, what is going to be the assumed rate of growth? And you can get huge variations. And for instance, the regulator, the Financial Services Authority, lays down certain parameters for illustrations, because we used to see in the past that there was a bit of naughtiness in terms of projecting very high figures. And for instance, if you have an asset in cash, it may be earning, 0.2%. Well, you can't project that at 5%. That is plainly ridiculous. But you may be wanting to project over a longer period of term in terms of investment growth, and therefore a range of 5 to 7 may be appropriate. And that is going to have a huge effect, because what you're effectively going to be doing is you need to accumulate a fund. And that fund size is going to be dependent, at the end of the day, in terms of the income, how long are you going to live? So another driver is actually going to be, when are you going to retire? Plainly, if you retire at 55 and you live to 90 or 100 or 111 was the latest, the oldest person that's just died in the UK, that maybe is where you'd be cute and have an annuity, because the insurance company or the annuity provider would certainly be crying. So it is, there are a number of drivers here, and what I'd suggest, Peter, is we'd be very happy if you wanted to write in with your particular circumstances, your particular income needs, is based on today's parameters. We could do that calculation for you if you were wanting to do that on an unsecured pension, for instance, and we can generate the illustration to show you how much fund that you would need to accumulate. But remember, these are only illustrations. Nothing is guaranteed here. And for it to come true, then you would have to, for instance, meet the investment assumption.
And can I just add to that you will find on the Self-Trade website, there's in our research section, there's a tab of tools, and there's some calculators in there, and you can play with some of these numbers. So you can put in lump sum values, you can put in monthly contributions, periods of time, rates of growth, and you can work out either upwards, how much would this fund create for me, and then you could look at some of the annuity sites and see how much that might buy you as an income, or you can work it back the other way. If I want a target fund of X, what do I need to put in? So between the two of us, I think we could probably answer that one for Peter.
Well, I think certainly we can, but I think the old adage is absolutely true as always. The earlier you start saving, the better. Unfortunately, the way lifetime circumstances are at the moment in terms of paying off student loans, buying houses, bringing up a family, there are a number of challenges to be able to fund pensions. And therefore, what we're seeing is many people really starting pension provision or contributions to pensions quite late in life. And that's a very short time scale if you're thinking in terms of retiring at 65 or 70, for instance.
Indeed. Thank you. Robert's obviously looking forward to taking some of his pension benefits, and he's asked a question, Francis, about drawing down the 25% tax-free lump sum. Can you do that in stages, and how would that work?
Yes, certainly, and indeed, if you had different arrangements scattered around, although one of the great benefits of SIPs is to be able to pool all your arrangements together. Yes, you can, and effectively we can effectively crystallise a certain proportion of the fund, pay out the pension commencement lump sum, and then no more pension commencement lump sum, if you take the 25%, can be paid in respect of that proportion. Now, this is where it gets slightly more complex, because we then have to issue a bit of paper back to you to say how much of your tax-free lump sum in terms of the maximum permitted under your lifetime allowance you've taken. And then if there's another, if you had another arrangement somewhere and you were looking to take benefits, they will need a copy of that certificate in order to work out effectively the proportion of tax-free cash that could potentially be paid, or whether in fact you've exhausted it.
Okay. So a couple of little wrinkles to be aware of in there, and I think clearly to take some clear advice when you get to that point about how you want to draw that.
Could I just jump in actually and say, and one of course things that's about to happen is of course there's going to be much more flexibility on taking tax-free cash in the future under the government proposals, where they're proposing to allow tax-free cash to be taken after the age of 75, 77.
Okay, good. Well, thank you for that. And Sarah's asked a sort of related question to the one about what happens on death, and this is, can I transfer all or part of my SIP to someone else?
Well, I'm just trying to work out whether this is a question actually about death. Now, I've covered the situation on death, which is in a pre-crystallised situation, i.e. before you take retirement benefits. Then the fund can be paid out to nominated beneficiaries in full, subject to lifetime allowance limits, and that's tax-free. I've also covered the situation that if you started to take benefits, the tax situation and the options there. But also there's the sort of subtle thing of, well, could I transfer it to another relative? Well, the answer, I'm afraid, is no. Personal pensions are personal pensions, and you can't just divide up your SIP. And indeed, there's been a very strong view within HM Revenue and Customs that pensions shouldn't be used for generational shift of assets.
Right.
And this has been behind the driver for compulsory annuitisation, etc., this trying to stop funds being handed down. Personally, when we were lobbying for pension simplification, one of the things that I've actually lobbied very strongly for is part of the ability within death benefits or in terms is actually to be able to fund the pensions of the active pensions of perhaps other family members. And as you have pointed out on more than one occasion, my son Archie, I think it would be nice that if I had a large fund, that part of that could go to help fund Archie's SIP. I don't know. It's a big cliff we've got to deal with here. But I think that degree of flexibility where, if we're all honest, pension saving is woefully short across the nation, that it seems a shame that we can't protect some of that, even if it's taxed at perhaps a slightly lower rate.
Well, the government is talking, and the industry is talking about a lifetime savings scheme that will offer people more flexibility to cope with changing lifestyles. So maybe there'll be a chance for you to reopen that debate, Francis.
Well,
I'm sure you'll contribute to that as you have done in the past. Barry's asked a question about investing some money, and let's use the example of £5,000 into a deposit account with a bank, claim 20% tax back from that, and then draw it down. I'm not quite clear in my own mind what Barry's question is related to, but perhaps you might be able to shed some light on that.
I think, Barry, we need to put this into the context of pensions, and you need a pension scheme if you're going to do this investment and claim your basic rate tax back. So I think essentially what you're trying to say, Barry, is that you want to make a £5,000 contribution, You want to get basic rate tax on that. Well, the only way you can do that is to make it into a pension contribution. But no, it is possible to draw it down. But what you need to be looking at here is the expenses of setting up the arrangement. Effectively the returns you're going to get out of it. And in all situations, although it's very attractive to say, well, I can get tax relief on the way in, you're also going to pay tax on the other side. So I can't give tax advice, but I would say there are other products out there, like perhaps an ISA, where, okay, you don't get the tax relief, but you will get a tax shelter in a cash ISA, for instance, and much more flexibility in the way that you can draw down the benefits. So it's never, in my mind, a question of tax savings, ISAs, or pension SIPs being better than any other type of savings. What you need to do is to look at the most appropriate type of saving for your circumstances.
Thank you. And I think I'm right, Francis, in that Barry's contribution, if it were to be made into a pension, would need to relate to his income as well.
Absolutely. Barry would need, in those circumstances, to have an income of at least £5,000.
Indeed, to make that good. Okay, thank you for that one. Shamir's asked us a question about the earliest retirement age that one can retire at the moment and start drawing from a SIP. I think earlier we were saying 55.
55, although we made the caveat about serious ill health commutation and we made the caveat about ill health.
And Shamir, if you're a gymnast, then you may be able to qualify under the...
Well, no, not under the change, you see. This is when simplification came in, the government was very firm about bumping it up to 50 and to 55. So, yes, you could effectively retire, but essentially you had to then defer it.
So perhaps you might need to stay a gymnast for a little bit longer. Okay, so I think we've answered that one for Shamir. Thank you on that one. Gary's asked a question to do with defined contribution scheme. So he's got a pension pot already. It's partly provided by his employer and joint contributions from the two of them. And he wants to know if he can move that to a drawdown pension as a right. Can he enforce the transfer? And if so, does he need to take the 25% tax-free lump sum when he makes that transfer?
Yes, I mean, Gary, as ever, in doing a transfer, you need to look at all the pros and cons of making that transfer. And if you're in an employer-based scheme, it may be you're under final salary rules, although it's a cash contribution going in from your employer. And if so, it may be that the lump sum provisions, depending on your years of service, could be more beneficial. So it may not be quite as simple as making the change. However, yes, in principle, you can make a transfer from a defined contribution arrangement to a personal pension arrangement, and then the 25% rule will apply in terms of tax-free cash. And provided you're over the age of 55, then you can commence a drawdown pension. Okay.
And the sort of second part of Gary's question is, so if he did transfer it across after the age of 55, he wouldn't have to take the 25% at that time. He could defer that until later.
No, and I think this is one of the interesting parts of the government consultation, as we were saying earlier, is that effectively they're looking at making the flexibility in terms of taking pension commencement lump sum easier and at older ages. Now, one of the things that one of the gotchas that we've had up to now is if you crystallise benefits, for that proportion of the fund, if you don't take your tax-free cash, you lose it. So this is going to be one of the interesting things to see, how is this going to work in the future. Typically what actually happens is that people crystallise benefits to take the tax-free cash, maybe to pay off part of the mortgage or to deal with, some family circumstance or whatever. And then actually more typically what they do is they don't take any income and continue to invest the fund, although they can then dip in at any time. Sure. And just perhaps remind everybody that within unsecured pension, around the government calculation that we have to do, has always been the range up until now of taking between 0 and 120, but always the flexibility to be able to take income even if you don't start taking income at a later date, provided you don't go over the annual limits.
Indeed. Well, we've got time for a couple of quick questions. We've answered Stuart's, I think, in what you were talking about earlier, Francis, when we talked about Stuart's question is, what happens if I die before I start taking retirement benefits? So I think we've covered that one, Stuart, for you there. An interesting one from Pauline. So you can start drawing from age 55, but can you still be paying in while you're drawing at the same time?
Well, essentially, we can create new arrangements. So, you know, I mean, at the end of the day, you could be drawing down from one arrangement and paying into another. So, you know, that can be done within the same operator as well. So,
and would you get the tax benefit back on the money you've drawn out and paid back in again?
well, I mean, essentially, you're going to be taxed at your marginal rate on the money you're taking out. The one thing that you know, I've warned in earlier webinars, is that what you mustn't do is get into tax-free recycling, tax-free cash recycling. So what you can't do is take some tax-free cash and then recycle it, because you'll have HMRC to answer to. They banned recycling.
That sort of sounds reasonable. That sort of sounds reasonable. So, Pauline, we've covered that one, and I think we've covered James's question about can you get hold of your money before 55, and the example of a serious illness you mentioned earlier, Francis. So James, yes, but you would need medical confirmation of that.
Yes, sadly, you know, we have to make sure that any such claim is supportable. Because at the end of the day, you've got the draconian situation as if HMRC, and this is why I wanted to go into the taxable property unauthorised payments, is that if it's an unauthorised payment, then the tax consequences are horrendous.
Good. Well, thank you all very much for joining us again this evening. Thank you for your questions, both this week and in earlier weeks. As before, this session has been recorded and will be available on our website shortly. So if you want to rehearse some of the slightly more complex topics that we've needed to discuss this week, then you'll have the opportunity to do so. We'll add some of that content as well to our website, particularly about the proposed changes, so you can keep track of what's going on with those. We've certainly enjoyed presenting these events. I hope you've enjoyed and have gained a lot from them. I'd like to thank Francis for putting his time available and his expertise and having it here for you to take account of. So thank you very much, Francis, for coming along.
Much enjoyed, Dave. Thank you.
We've certainly much enjoyed it. I hope you have too. Do let us know if there's other topics you'd like us to cover. Who knows, we could be back here again in the future presenting some more webinars for you on the subject of pensions. So if you've got questions, do send them in. We'll do our best to answer those for you. And as I said before, if you could be so kind to let us have your feedback, we very much appreciate that. Let us know what you like, what you don't like, and what maybe we could do for you in the future. So thank you very much for joining us. Have a pleasant evening, and we hope to see you again soon. Thank you very much. Bye-bye.
Bye-bye.